The first half of 2025 has been a roller coaster for global energy markets, and the second quarter delivered plenty of surprises. The 12-day Israel-Iran war sent oil prices briefly spiking into the $80 per barrel range, but that didn't last. Markets quickly refocused on fundamentals like supply and demand and on growing concerns over U.S. trade policy under President Trump. But the real shock wasn't about oil, it was regional gas supplies that took the hit. Gas shutoffs during the conflict exposed just how fragile domestic energy systems are across the Middle East and North Africa. Even before the fighting, countries like Egypt and Iraq were already struggling to meet summer demand, which is a trend that's becoming the new normal. The main drivers are surging electricity demand, especially for air conditioning, and persistent natural gas shortfalls. Some countries are adapting. Bahrain is importing LNG for the first time, and Egypt and the UAE are relying very heavily on pipelines. But regional energy integration remains limited and is still vulnerable to shocks. Meanwhile, wealthier Gulf states are widening this gap with new renewable projects and upstream gas investments. That's leaving more vulnerable countries behind, even those that technically export energy themselves. At the same time, though, state-owned energy firms aren't slowing down. They're investing heavily at home and abroad, especially in the U.S., where Trump's recent visit reinforced an investment-first strategy. We're seeing a shift from the old energy for security model to a two-way flow of energy investment between the U.S. and the Gulf that includes LNG, petrochemicals, and even carbon capture. And despite global setbacks on climate goals, renewables are still expanding in the Middle East and North Africa. Renewable energy now accounts for 10.8% of installed power generation capacity in the region, while total generation rose to 3.4% in 2024. That said, natural gas is still king. Renewables and nuclear are growing, but they're a long way from replacing hydrocarbons. And as U.S. policy drifts away from clean energy, China is stepping in, helping countries like Iraq develop solar and wind. One last wild card is that OPEC Plus surprised markets by boosting output, adding over 500,000 barrels per day from August. It's a move aimed at regaining market share and squeezing out high-cost producers, especially U.S. shale, even if it means lower prices in the short term. So what should you watch in Q3? The big variable is still the Trump factor, especially trade policy and tariffs. But don't overlook the region's own momentum. MENA countries are building out renewables, expanding LNG infrastructure, and rethinking energy security with or without U.S. leadership. For a deeper dive, check out my full MENA energy recap report for Q2, now on MEI's website. Thanks for watching.